What is future value? Time value of money is the first basic principle of finance. The essence of the time value of money concept is that a dollar today is worth more than a dollar in the future. If you have the dollar today, you can invest it and earn a return on it so that on any future date, you'll have more than a dollar. This is the future value of the dollar. If you consider investing it for several periods and in successive periods expect it to earn returns, then this process of calculating future value is called compounding because it includes earning returns on returns. In every period, you are earning a return not just on your original investment, but also on all returns you have earned until then. So far, we have not imposed any requirement that the periods be equal, just that each return be appropriate for the length of the corresponding period. The first period, then, may be a year, in which case the return will have to be an annual return. The second period may be a month, in which case the return must be a monthly return, and so forth. This is the general way for calculating future value over time, where the length of each period and the rate of return for it can be different. If we assume that all periods are equal in length, for example 1 year, and all the expected returns are the same, then the calculation of future value becomes a much simpler process. This process can also be undertaken in reverse. Assume that instead of asking what a certain amount of money today will be equal to at some point in the future, we ask what a certain amount of money in the future is equal to today. We then must reverse the calculations. The process of calculating present value is called discounting, which is the inverse of compounding. This also involves earning a return on return, although it is not easy to see it here as it was in the case of compounding. Calculating present and future values can also be viewed as the process of moving an amount of money forward or backward through time. The amounts of money involved are called cash flows because they involve cash as opposed to some accounting measures like earnings. It is easy to see that if we are anticipating several cash flows over time, we can calculate the present value of each and then add them together to get the total present value of all cash flows. Here are the key points to keep in mind about calculating present and future values and doing time value of money problems. The time value of money concept applies only to cash flows because we can earn returns or must pay returns only on cash we invest or borrow. We cannot calculate future values or present values for net income, operating income, and so on, because they do not represent cash. Only cash flows taking place at the same point in time can be compared to one another and combined. If you are dealing with cash flows that take place at different points in time, you must move them to the same point in time. That is, calculate their future or present values at the same point in time before comparing or combining them. For such calculations, most of the time we either present value or all cash flows to today, or future value them to the farthest point in time the problem involves. However, if it is more convenient in a specific situation, we can move all cash flows to any other point in time as well. Whenever you calculate a present or future value, especially using Excel functions, make sure you know which point in time they relate to. The simpler formulas, as well as most Excel functions, can be used only when all the periods are of equal length and the rate of return is the same for all periods. Otherwise, you must use the longer period-by-period formula. We use the term compounding when we calculate future values or move earlier cash flows to a later point in time, and the term discounting when we calculate present values or move cash flows to an earlier point in time. However, we often use the term discount rate to refer to the rates of return in both cases. The most important thing to remember about the discount rate you choose to apply to one or a series of cash flows is that it must reflect the risk of the cash flows. It is easy to understand that the discount rate should be higher for more risky cash flows and lower for less risky cash flows. However, estimating the risk of a cash flow and deciding what the appropriate discount rate for it should be is one of the naughtiest problems in finance.